Why? The same reason Norfolk Southern cuts cost at the expense of safety, eliminating one because of trade deals that they lobbied for. And Wall Street demands they post profit increases, even in the middle of a global pandemic. That's the problem with our economy. And not only will higher interest rates not solve it, if they're overdone, they'll make it worse. We can't risk undermining one of the successes of our current economy. For the first time in decades, workers are finally starting to get a little power in this economy.
Hey.
Unemployment's at a historic low, 3.4%. That's not just a number. That means Americans have more opportunities, more options, even in places that haven't seen a lot in recent years. It means people have the power to demand raises and retirement security and paid sick days and some control over their schedules. It means more Americans have the dignity that comes with a good job that provides for your family. We must here ensure that all Americans have the opportunity for that dignity of work. It's a critical time. The consequences of missteps could be severe. Mr. Chairman, two more things that affect your job. It's not just monetary policy that threatens American pocketbooks. Some of my colleagues have threatened the nation's full faith and credit by holding the debt ceiling hostage for partisan politics. Instead of paying our bills on time, they're essentially threatening all Americans. The Fifth Circuit's Consumer Financial Protection Bureau ruling could also cause unimaginable instability and chaos for families, for consumers, but also, as the chair knows, for a financial system. The Fifth Circuit is Wall Street's, no doubt about it, the Fifth Circuit is Wall Street's favorite courthouse. It recently ruled the CFPB's independent funding is unconstitutional. If the Supreme Court upholds the Fifth Circuit's ruling, it will not only devastate CFPB, it will threaten the independent funding of many other federal agencies, including the Federal Reserve. I look forward to today's hearing, how the Fed will balance its dual mandate and continue to promote an economy where everyone who wants a good job can find one, an economy that works for everyone. Senator Scott. Sorry.
Sorry. Good morning, Chairman Powell. Sitting here, looking at my prepared remarks, thinking about, there's an opening coming where Vice Chairman Brainer's moving on. I think it's really important for us to make sure that all the information that we need in order to make a good decision on the next nom that we have in a timely fashion. So I would really implore the chair to make sure that happens, that every question, every questionnaire that is asked from the person, we get. Every member of this committee has their questions answered in a timely fashion, and that the staff has their answers in a timely fashion. Listening to Chairman Brown, I thought to myself, fascinating, truly fascinating. I concluded that, well, I know Chairman Brown pretty well. I am sure he is sincere in his rant. But let me just say this. Spending and printing trillions of dollars, caving to the radical left in this country, seeing policies posited and then implemented that led to the worst inflation in 40 years. Seeing our inflation at 9.1%, seeing American families struggle because of the weight of the government on their shoulders, seeing the devastation from South Carolina to Ohio. It's unbelievable that the progressives in this country who caused a 9.1% inflation would then turn somewhere besides in the mirror to see the absolute devastation caused by their out-of-control spending is remarkable. Remarkable. To stop the out-of-control inflation caused by the out-of-control spending, the Fed steps in to cool the economy.
Hey.
Well, the definition of cooling the economy is necessary because we've seen the most radical approach to a problem that was in our rearview mirror being used as a Trojan horse to bring in a level of socialism and spending that our nation has not seen in my lifetime. The facts are very simple. When you get to 9.1% inflation in this nation, as a kid who grew up in a single-parent household, mired in poverty, a 40% today, 100% just a year ago increase in the gas prices devastates single mothers around this country. For seniors on fixed income whose savings are being depleted with an average cost just last month of a $433 increase because of inflation. For my friends on the other side of the aisle to look any place besides a mirror, I find stunning. The truth is that when your food prices go up over 20%, when your electricity is up over 20%, you have to ask yourself, where in the world are they? They cannot be in this universe. It must be an alternate universe where, in fact, it's okay for us to see prices go through the roof and our economy not stumble, but fall into a ditch. Why are we in the ditch? Because progressives used the pandemic as a way to usher in a form of spending that takes the money out of the pockets of everyday Americans and puts it in the coffers of the government. There is a better way. The better way is to trust the American people. And when you do so, we don't have to have the Fed come in and raise interest rates so high to quell the challenges in our economy so that today versus 18 months ago, the price of the same house for your mortgage payment is twice as high. Why? Because of the runaway spending of our friends on the other side of the aisle. I'm sure I do not have time for my opening comments, but I will say without any question, as I look around the country and I ask myself, how devastating is it that today it costs $433 more than it did a year ago? The answer is it is a crisis. When the average family in our country just a couple of years ago didn't have $400 in their savings for an emergency, to have prices go up by this amount, it's devastating. To have a conversation about rents around the country, looking at the inflationary effect and the absolute devastation of a snarling supply chain we haven't seen in my lifetime, run by my friends in the progressives. Unbelievable. But to get to you, Chairman Powell, one of the comments that you've made that I think is really important in one of the speeches you gave in January, and I apologize for my rant. I just wanted to make sure my rant was consistent with my friend here. It is essential, you said, that we stick to our statutory goals and authorities, and that we resist the temptation to broaden our scope to address other important social issues of the day. Taking on new goals, however worthy, without a clear statutory mandate would undermine the case of our independence. You further noted that, and I quote, without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools to promote a greener economy or to achieve other climate-based goals. We are not and will not be a climate policy maker. Do you still stand by those comments?
I do.
Thank you. Finally, I know we're not in the question. I know, I get it. Finally,
4 minutes and 12 seconds.
yes, I knew the chairman would dock that from my time, and I appreciate you doing so
With a sense of humor.
with a great humor, great humor. Finally, several of my Republican colleagues and I sent a letter to you discussing Vice Chair of Supervision Michael Barr's plan to conduct a holistic review of capital standards. I look forward to discussing those capital standards during my Q&A, and I will thank you for our recent conversation that we had that helped illuminate some of the necessary challenges that we face as a nation and your answers to it. Thank you, Mr. Chairman.
Thank you. Speaking of illuminating, thank you, Senator Scott.
Yes, sir. Thank you for allowing me to use this.
Today we'll hear from Chair of the Federal Reserve, Jerome Powell, on monetary policy in the state of our economy. And I don't expect Chair Powell to weigh in on the mini debate we just had, but I think we all know that the debt increase was much larger under President Trump and a Republican Senate than it has been since. Chair Powell, thank you for your service and your testimony today.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. Our policy actions are guided by our dual mandate to promote maximum employment and stable prices. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. I'll review the current economic situation before turning to monetary policy. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we'd seen in the data just a month ago. Some of this reversal likely reflects the unseasonably warm weather in January in much of the country. Still, the breadth of the reversal, along with revisions to the previous quarter, suggests that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above the FOMC's longer-run objective of 2%. The 12-month change in total PCE inflation has slowed from its peak of 7% in June to 5.4% in January, as energy prices have declined and supply chain bottlenecks have eased. Over the past 12 months, core PCE inflation, which excludes the volatile food and energy prices, was 4.7%. As supply chain bottlenecks have eased and tighter policy has restrained demand, inflation in the core goods sector has fallen. And while housing services inflation remains too high, the flattening out in rents evident in recently signed leases points to a deceleration in this component of inflation over the year ahead. That said, there is little sign of disinflation thus far in the category of core services excluding housing, a category that accounts for more than half of core consumer expenditures. To restore price stability, we'll need to see lower inflation in this sector, and there will very likely be some softening in the labor market conditions. Although nominal wage gains have slowed somewhat in recent months, they remain above what is consistent with 2% inflation and current trends in productivity. Strong wage growth is good for workers, but only if it's not eroded by inflation. Turning to growth, the U.S. economy has slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Although consumer spending appears to be expanding at a solid pace this quarter, other recent indicators point to subdued growth of spending and production. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight. The unemployment rate was 3.4% in January, its lowest level since 1969. Job gains remained very strong in January, while the supply of labor has continued to lag. As of the end of December, there were 1.9 job openings for each unemployed individual, close to the all-time peak recorded last March, while unemployment insurance claims have remained near historical lows. Turning to monetary policy. With inflation well above our longer-run goal of 2%, and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of interest rate increases over its past 2 meetings. We will continue to make our decisions meeting by meeting, taking into account the totality of the incoming data and their implications for the outlook for economic activity and inflation. Although inflation has been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Federal Reserve, we will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you, Mr. Chair. There are 23 of us on this committee. Almost everyone will be here today. I ask each of us to stay as close to the 5-minute mark as we can because we have votes at 11:30. So thank you all for your cooperation. Chair Powell, thank you. Job growth is strong as unemployment remains historically low. You might not know that from the opening statements. Many drivers of inflation, corporate greed, rising inequality, supply chain disruptions, Russia's bestiality, if you will, in Ukraine, won't get better because of interest rate increases. Every indication is that this post-pandemic economy is different. Should we be worried, Mr. Chair, that the Fed is treating this economic period as it has in the past instead of reacting differently?
Thank you, Mr. Chairman. So we've been aware since the very beginning and have discussed this publicly on many occasions that there are some differences this time. We, in particular, have not seen the kind of supply side collapse that we saw at the very beginning of the inflation outbreak. Also, the outbreak of a war which had significant effects on commodity prices a year ago. So all that is different. There are also, though, some similarities. There is a mismatch between supply and demand.